Good morning, guys. Today is February 20th, Tuesday. Hope all of you guys are well. Today, I think the market is taking a break from just so many weeks of going up. So I think it's going to continue to do that. Most people would expect this. So it's not like it's new news to most of you guys. Since the end of January, beginning of February, a lot of people have been calling for a break in the market, at least about a 3 to 5, maybe some people have been calling for a 10% correction in the indices, which means lower stock prices for almost all across the board. So keep that in mind while I discuss some of the opportunities that are coming with a deep dive in some of these companies. And my intent is to give you a complete picture of the company as you do your due diligence to understand what the company actually does if this is a company that shows up on your radar screen. You can use my videos as either ideas for company to research, learning about companies that you already hold, or to be able to find out what might be interesting in terms of a new opportunity for you to consider. So all good for you in those three areas. One of the companies that has showed up consistently on the radar screen is Applovin. APP is the ticker symbol. Now, what Applovin does is easy to explain, but a little more sophisticated to be able to understand beyond the surface. At a very simple level, Applovin does two things. They make about 200 mobile games that people use. Then they get the data from the people using those games, and they provide an engine, a software, Axon, that allows other people to be able to use that engine within their games and help them market and make more money from those games using ads. So display advertising on mobile, they do it with their own in-house first-party games, and they also provide an engine. So in some ways, they compete with the Unity. In some ways, they compete with a few of the other ad tech players, both on the demand side, such as Magnite and PubMatic, and also on the sell side. So let's look at what they do, tell you a little bit more about the company itself, what are their key products, why I like the ad tech space, what are the good opportunities in the ad tech space, and then we'll go from there. Applovin has been around for a little bit of time. They're based in New York. The company went public almost about 3, 4 years ago, and they've taken a beating since the initial IPOs. They went initial IPO, stock moved up, just like with everybody else during the post-COVID 2021-22 timeframe. They just moved all the way down, found a very good base in the $10 range. Now they're at the $50 range. So they've gone up 500 times since their lows, but still, is this an opportunity to consider for the long term? Okay, so let's take a step back. I want to give you a little bit of a sense for both of you, for those of you that may not understand the space very, very well, because you know ad tech, you've heard of Google, you've heard of Meta, they all do advertising online, digital advertising. The digital advertising space has got a lot of different types of companies, a lot of different players, because this is a trillion, almost going to be $1 trillion market worldwide. So this is a large market. Spending online in ads comprises of multiple different types of ads. It could be a display ad that you might see as a banner ad or as a skyscraper when you go to certain websites. It could be a little video ad, which is a different format. It could be a search ad on Google, which is called paid advertising. So all of these different types of ads together make up $1 trillion market. Now, there is the advertiser. This could be a Coke, this could be a Nike, or in other ways, it could also be a very small publisher or a restaurant that wants you to be able to come in and eat at the restaurant. So advertisers on one side want to be able to get their message out to consumers on the other side. So between the consumer and the advertiser is where the ad tech market plays. The consumer will typically go to a publisher of content. This could be ESPN.com, it could be New York Times, it could be CNN, it could also be on your mobile phone games that you play. They are also a publisher. They're a game publisher as opposed to a news publisher. So keep that in mind. Publisher is anybody that serves up inventory in terms of content that people can consume that they monetize through ads. So that's the publisher. So now, the challenge is a lot of publishers exist, millions, if not more than millions of publishers. So when the millions of publishers exist, the sell side platform aggregates a lot of these publishers. So SSP, quite a few of these as well, and a real-time bidding engine, real-time bidding server. So what happens is when a page shows up for a consumer, immediately on the page, there are ad opportunities. There could be a skyscraper on the side. There could be a banner ad on the top. There could be a bunch of smaller ads. There could be a video ad. Now, this inventory is available and is aggregated because a single advertiser can't go to every one of those millions and millions of publishers and negotiate deals with them. So the sell side platforms aggregate all of those. Then the sell side ad platforms, along with the ad exchange or ad network, I'll explain what the difference is in a little bit. But the sell side platform works through ad exchanges or ad networks. Then on the on the advertiser side, they typically have DSPs, which is a demand side platform. So very similar to being able to aggregate a lot of suppliers, which is the publisher side. The DSPs also are getting aggregated. DSPs aggregate demand from a lot of, for example, Coke might have 15 different brands and they want to be able to advertise differently for those. Or Coke versus Pepsi, they also get to be able to go ahead and say. Now, typically, most of these guys go to an ad exchange first. That's the preferred route. An ad exchange essentially, for example, Meta offers an ad exchange, Google offers an ad exchange. They bought a company called DoubleClick and they offer it through that. So ad exchange is the preferred model. Ad networks are a little bit more for second tier inventory. So publishers publish a lot of content. They tend to typically sell that content that is premium directly to advertisers. So they like to have the direct connection with the advertiser. For example, some cases you might see ESPN has ads completely taken over by Pepsi or Gatorade during the NFL. That's a direct relationship that's for premium advertising inventory. Now, when the premium ads, but because they produce so much content, there are so many pages where you can serve ads, they also make it available through ad networks, which is the second tier inventory. Maybe not a page that is being followed too much, or maybe a page that doesn't get too much in terms of views. So ad exchanges allow advertisers through their agency. So an agency is a marketing buying agency. The advertisers say, I've got 10 million to spend. They give it to an agency and say, make sure you get me these based on the goals I have together. All of these agencies together, the bids that they place, real-time bidding, the client side is aggregated by the DSP, demand side platform. They work through ad exchanges or in some cases ad networks over across to the sell side platform and actually goes to the publisher and the consumer gets it. Now, all of this happens in micro milliseconds, nanoseconds, very short amount of time. So when Coke already says, I want to place this ad for everybody who's between 45 years old and 50 years old, just as an example, guys between 45 and 50 years old who are watching NFL, every time they go to either a mobile phone app or they go to the mobile ESPN app or they go online, immediately there is a request that's made saying, hey, there's somebody who's 45 to 50 that we know from their cookies and their profile that is watching this page. Do you guys want to bid on this? And then there's an active bidding that appears. So Coke might want to place the ad, Gatorade, Powerade from Pepsi might want to place the ad. So they bid against each other and say, I'm willing to offer 3 cents for this, or I'm willing to offer 5 cents for this. As that bidding happens in real time, it is negotiated and the ad is served. And then immediately that gets billed back to the advertiser. This happens in real time. Another way of looking at it in a simple way, if you will, was previously. Now I'm giving you a little bit more of a peel the onion kind of a way. The largest publishers, for example, ESPN, CNN, they actually deal directly with the brands and the agencies. And what they do is they say, I will take your requirements and I will make sure that we will give you premium inventory for you available at this point in time. Now, above and beyond that, some publishers also have their own ad network. What ad networks do is they aggregate the inventory through a DSP, and then they will do measurement and targeting. For example, they say, I want to target all 25 to 50-year-olds in this specific area. So they will measure how many people come in, then they will make sure that they place those ads. Most publishers will run multiple ad networks. They'll run DoubleClick from Google and they'll run Meta from Facebook as well, or Facebook ad network as well, because they know that they will be able to go ahead and have inventory to be able to serve multiple networks. Sometimes what happens is agencies will work through an ad exchange for not premium inventory, just a lot of inventory. Again, aggregate that goes through an ad exchange. So another way to look at it, same thing, no different, but the consumer is to the right from my point of view, the publisher, this is where the consumer is. Let me draw that out for you. So this is where the consumer is. They're viewing content, coming to a publisher and viewing the content. This could be mobile, could be on your desktop, could be on your iPad or your tablet, could be even on your car. So it could be in multiple different places. So typically, the big brands or will work through agencies to directly go and use the premium content. But the big brands also, when they want a lot of spend to be able to manage through um, other networks, they will go through an ad network that then aggregates from the DSP side. Sometimes when they want not for premium network, they might go through an ad exchange. In a complicated way, there are thousands of players in this market. So I want to show you this so you can get a good view of the fact that this is a very diverse, fragmented, and sophisticated market for most parts. So even though I explained there are DSPs and there are SSPs and there are agencies and publishers, so publishers and marketers, same thing. This shows you that there are so many different players. DMP is a demand management platform, and data aggregators or data management platform, data aggregators. There's so many different players, each within the niche. There are literally thousands of companies operating in the space because you make $1 billion. As you know, even if you own 1% of this market, that's $1 billion. This is $1 trillion market. So people are trying on an ongoing basis to be able to get into this. So this is a complicated view. From a public market perspective, if you look at it, one of the companies we're talking about today is Applovin. It's right here. So there are software providers, there are platform providers, service providers. I made it simpler. End users are publishers, sorry, end users are marketers, brands or advertisers. You can give multiple names to the same ones. Of course, there are a lot of different companies such as Trade Desk as well. And there are a bunch of regulatory bodies. The regulatory bodies are needed primarily to make sure that there is no spam and there is no fraud in the system. Digital marketing, 1.26 trillion by 2026. So it's a very large market growing consistently. Where is this market growing? Why is it growing? A lot more people now have the availability to be on their phone individually, as opposed to previously you had to go through TV or you had to go through uh, non or analog mechanisms, television, newspaper, outdoor media, etc. Now you can do it digitally. So instead of having 3 billion people watching television and there's only one single or two single types of ads you can place here, now you can do it for each individual. You can personalize the content. The market has just grown from that perspective overall, and a lot more money is moving away from analog and older mechanisms to digital mechanisms. So the forecast just within the ad tech market, so this is the overall ad market. Okay, that's $1 trillion. The ad tech market itself, which is the technology supporting, go back to this chart. This is the technology that supports the entire market. That itself is over $1.4 billion. So that's a lot of money. The display advertising is again a part. Let me walk through this again. Just to summarize, the overall ad market is about $1 trillion. The ad technology market, ad tech market is smaller than that, about billion four. The display advertising is one of the forms of advertising. It could be display advertising, it could be paid search advertising, and so on and so forth. So display advertising itself is a $200 billion market growing fairly well. As a percentage of total media spend is about 40%. So display is about 50%, roughly, more or less. And search ads tends to be the remaining 50%. Google is primarily the 90% of that market. Now, let me take one step now deeper into this. If you look at the companies that provide, this is one view, and this is a little bit of a biased view, but they do provide marketing intelligence. This is also a little bit dated. Unity tends to be the number one company that tends to be compared to Applovin to a large extent for one portion of the work, which is they provide an ad engine as well. They provide a Unity engine, which is the Unreal engine to be able to build apps on top of for mobile developers. Applovin does that as well as a software component. There are companies like Apps, which is Digital Turbine. So that's the summary so far. The ad exchange essentially is an online marketplace. Publishers can make a request and say, hey, I have this inventory to be able to provide brands and agencies or marketers or consumers, not consumers, sorry, publishers, advertisers will come back and say, we want to bid on this and purchase this inventory. The DSP is the demand side platform. They aggregate from across all of these exchanges into one place, which makes it easier for the marketer to say, I want to buy it here, I want to be able to buy it there. So they don't have to worry about ESPN versus ABC versus Disney, etc. The sell side platforms lets the inventory to be published by the publishers and put it across multiple exchanges as well. And the data management platform, DMP, allows you to be able to store all of the data associated with the types of campaigns, with the measurements, everything in one place. Now, within this area, Applovin has about now 35%. This is about 2022, late 2022. So it's changed since then. Unity is still number one in this market, but Applovin is just executing better. And that's one of the reasons why I wanted to talk a little bit about this company. Okay, so there are three major things that Applovin does. Applovin, number one, makes a lot of games themselves. Free to play games. What does free to play games means? You will play the game. There are what 200 different titles. When you play the game, they show you ads. Based on those ads, they collect data. That data they sell as well to Google, to Trade Desk, to a whole lot of other providers. So that's the first part. Users download Applovin games, mobile games. They play those games. They have a studio to be able to produce those games, and they get first-party data from those games. The second part of them is the recommendation engine, which is the Axon solution, software solution. The data and the insights that they get allows them to keep making their software a little bit better. And then finally, because of that, they also allow, so this AppGraph and Axon infrastructure is for publishers of games, other publishers besides Applovin themselves. And then they help you monetize your games. So you can publish your game, you can make sure that you can build and publish your game using Applovin, and then you can monetize your game and make money. So if you are an indie developer that wants to be able to publish a new game, the first thing you will do is go ahead and build on top of Unity engine, which is from Unity or from Applovin. Second is you want to be able to start monetizing, make money on the game. And that's one of the things that you would also go to Applovin for. The first few, nearly close to 10 years, they spent a lot of time just building revenue from the standpoint of building a software platform that allows them to be able to do that. So initially, they built their own games. Then they launched AppDiscovery to help people monetize those games, grew revenue fairly well. Then they launched the Axon solution, and now they're doing a little bit more than that. This is 2021 data, just to give you a little bit of context. At the same time, they're making a lot more money just with selling software, which is a higher margin product. So platform, built the platform for the first decade or so, and then accelerating the platform the next last few years. So that's what they've done very, very well. So what are the key assets? They have a machine learning engine that allows them to be able to take the data from people that are playing their games, 200 different games right now, number one. That data allows them to be able to target specific sets of people, build insights on who those people are, and make that data available to publishers who can advertise on those, or they make it available to other publishers who are not from Unity, who can use that system to be able to build an engine on top of. They have a critical mass of first-party data. This is because of data that they have on their own games. And they're also rapidly getting a lot of people adopting their discovery, but also more important, their monetization solutions to be able to place ads on the games that third-party developers build and be able to get access to the network that Applovin offers. So that's the big shift. And the reason why I'm excited is now that they're making more money on their software, the flywheel is starting to work a lot better for them. So how does it work? If you're a developer or a publisher of games, the advertiser demand is aggregated plus the bidding engine, which is Axon AppDiscovery. And then the mediation platform allows other developers and other developers of games to be able to manage their mediation through that and say, how am I going to be able to ensure and understand I get the right ads on my games so I can make the most amount of money? And they have the software to be able to allow you to manage it through a license model. Very strong execution by Applovin over the last few years. In fact, they've been the quiet executor. One of the things that's really challenging about them is they don't share a lot of information. They're very much under the radar screen. Very few people know about them. A lot of people have heard of Trade Desk. A lot of people have heard of Roku, but very few people have heard of Applovin. So look at them. Take a look at this. They've executed very, very well. A little over $2 billion. Just look at the growth. Look at this growth, year over year growth. They almost grew $1 billion, 100% growth. They've since slowed down, as you can imagine. This was during the COVID timeframe, just to give you a little bit of context. And then as a software platform, they've continued to grow. It's just that people are now realizing that they're really, really good. And they have a lot of enterprise clients that use their solution to be able to both manage as an ad network, get the insights, and also place ads on them. So their software revenue right now is growing very, very fast, and that makes their overall margins grow very, very well. From their own content, they have about 33,000 developers of mobile games. They have 11 apps in the top games in the US. So most people don't even, well, you and I may not know a lot of the games, but word is a game. These are all games that people don't know and realize that Applovin is the one that develops it. They have 16 different studios. Each of these studios, as you can see at the bottom, tend to focus on different types of games. So it might be a single player game versus a casual game, things like that. And then over 200 different mobile apps for the games. So their software solutions itself. So remember, they make money by publishing games. They place ads on those games. They make money that way. They get insights and data from that, number one. Number two, they also sell a software platform that allows other people to build games, other people to monetize their games, and they make money on that as well. So those are the two parts of their business. So their software is built on top of their, as I said, Axon Mobile, ML engine, sorry, not mobile, and they're looking to be able to get nearly $1 billion in last year, 2023. They're already at over 2.5 billion now. So they allow you to be able to grow your audience with app discovery, monetize the audience through marketing, advertising, manage your top performing creatives with your Spark Labs, results by oriented management measurement, and then measure and manage your campaigns. So they also acquired a company called Mopub, roughly about a year and a half ago, 2 years ago, almost now, $1 billion for a little over $1 billion in cash. Mopub was actually first a part of Twitter, so they bought this from Twitter, just to give you a little bit of more context. And they allow you to be able to connect to a lot of different DSPs. So Twitter said, we're not going to run our own network, ad network. Twitter had its own ad network, and then they've now sold that off. Twitter now only deals with the large publishers, sorry, large marketers themselves, or anybody can go in and say, I want to advertise on Twitter. It's a self-service platform as well. They closed the transaction in 2022. So the business itself in an ad exchange online marketplace where publishers can publish the inventory, agencies can buy and bid on that inventory, DSP side and also on the SSP side. That's the big part of it. They went down quite a bit. We'll go through this seven-step process. The founder is still the CEO of the company, and the co-founder is in the company as well. Both, look at that, Adam and Andrew, they're still in the company. So they have roughly about now 200 games, not 350 games, 200 games. They keep cutting, adding more games across 16 to 17 different studios. They've got about 16 right now, 200 million active users who are using those games on a monthly basis. And in-app players, they have in-app games ability to be able to go out and not only place ads, but also have people purchase some of the revenue from in-app purchases. They make about 40% of the revenue from the software solution itself, higher margin software, and the advertising is about 20%. And in-app purchases from the games itself makes another 40% of the revenue. This is as of 2022. 2023, it's changed a little bit. I'll show you that when we get to the details. So strong growth, very good guidance that they gave in 2021, 2022. They've executed very, very well. Still a founder-led company. They have a combination of New York and Palo Alto is where they're based. Unity, of course, has a lot more customers on the DSP side, a lot more apps that are available on top of the Unity Unreal Engine, and they also help you monetize. So similar to Applovin, Unity also helps you both build mobile apps on top and also monetize. And they allow you to be able to directly manage into the Unity system. But Unity doesn't publish games themselves. That's a big difference between Applovin. So Applovin has, it's almost, think of it this way. Let's say you're Safeway and you sell only products from third-party companies like, for example, Procter and Gamble and so on, right? Now, you also decide to have your own private label brand to compete with the products from Procter and Gamble. That's essentially what Applovin does. But Applovin led with that private label first and said, okay, now we understand which games are working very well. So we're going to after these specific products or these specific gamers or these specific developers and get them on the platform, allow them to build it on top of the platform, then help them monetize the platform. That's how they're different. They have a niche product offering itself with data that's very difficult to get. So a lot of the data that they sell just as part of a DMP is offered to Google, Twitter. Almost everybody buys their data from them, mostly related to mobile games. Mobile games itself as a market is very, very large. Mobile gaming market is close to about a $32 billion market. So very large market. All right, so they have a lot of first-party data on their own from their own games that they publish. One of the big changes that has happened is Apple, if you remember IFAD, sometime in the 2021, 2022 timeframe said, hey, we're not going to let you guys especially Facebook or any other person who's developing, get data which violates the privacy of Apple users. So they put that in the same thing happened in Android as well. But what Unity does, sorry, what Applovin does, Unity does the same now, is get data directly from the consumers themselves. So they track the first party data. They make a lot more immersive ads, which is the other big trend that is happening within the mobile app system. And then the other shift is happening to mostly mobile-based games from console games. So those are the big shifts that are happening in the industry. Console games are things like PS5, Xbox, Nintendo Wii, etc. And now it's going more to the mobile side of things. And future would be more of the immersive games, something like the Meta Quest or the Apple Vision Pro. Very strong financially. We'll go through that when we get into the specific of the fundamentals of Applovin. The software platform itself has had very good growth. Revenue has been growing very, very consistently. They've moved up and to the right. Net income has been growing well. The app's revenue itself has been growing well. The software platform that they offer acts on and their ability to be able to raise that. Although from a little bit, they had a little bit of the publisher bonus that was moaned, they're still moving higher and to the right. And the retention rate for the software platform is close to 240%. That means people are coming and doubling down, literally, on the amount of money that they're spending with these platforms. So that's Applovin just as an overview. Now, what we're going to do is to be able to go through the 5-step process to see what we like about Applovin, what we don't like about Applovin from a fundamentals and from a technical standpoint. So we always start our 5-step process first with the fundamentals. So let me just make sure that I adjust this. There you go. Adjusted well. All right, let's go to the fundamentals and the financials. Annualized fundamentals is what I usually like and start with. So they were about $1 billion in 2018, less than a billion, and 3.8. So grown 3 times in the last 5 years, 3x. They've literally 3x here. Very strong growth. 45% growth, very strong growth during COVID. Everybody's sitting at home playing games. It's the same thing for SE, by the way. And then slowed down dramatically. So growing at about the 10% growth, a little less than 10% growth, not a great sign. Margins are very strong. Margins are in the 70% range. Gross margins are in the 70% range. And they actually turned a profit. So this is a good sign. So the PE will be a little bit high. Just keep that in mind. This is a company that is right now capitalized at almost $20 billion for $300 million net income. So this is going to be a 40, 50, close to 40, 50 PE. So this is going to be a high PE. Just keep that in mind when you're going through this. It still needs a little bit of a break. It's now a $60, almost $60 stock. Actually, it was a $60 stock and today it's down to 57. Okay, so after the COVID boom, going at 100% almost, it just slowed down dramatically, negative earnings growth, and now it's stabilized. Now it's back in the 35% growth. This is the reason why it's showing up on my radar. Strong movement and now starting to move up back again. That's why it's showing up. So after the lull, this is the calm, and this is phenomenal growth. 35% growth year over year. Again, off of a smaller base, Q4, that they actually reduced, and now they're going back again. So technically, this should be about a 20% growth had they kept themselves flat. Gross profit still in the 70% range. Net margins are also very, very good. Look at this. This is also very good. Their net margin growth is phenomenal. It's growing very well. Let's see the balance sheet. Total assets are about 1.3 billion in cash because of the acquisition. Yeah, intangible assets at 3 billion. Their debt is about, oh, that's a lot of debt. They have 3 billion in debt with only 1 billion in assets, in short-term assets. Wow. So this is if not a this is definitely yellow flag, if not a red flag. They have a lot of debt in their books. That's not a good sign. So on a scale of 1 to 10, let's finish the rest of it. Good cash flow. Cash flow is not the problem. Let's look at their margins and PE. The PE is 60, so that's very high. For a company now growing at 35% PS is good. The earnings, sorry, are growing at about 100% or something, 300% last quarter, but growing very, very well consistently. I wouldn't say that they would be able to continue their 300% earnings growth, but let's assume that they can do at least 100% earnings growth for the next foreseeable couple of quarters. So this is high, 6 times PES ratio. 35% is not bad. It's not bad because their margins, gross margins are 70%, net margins at 20%. So very good margins. The debt is an issue for me. 3 billion in debt with only 1 billion in cash. So it's a little bit of a challenge. Valuation 60 is not bad given that the earnings are growing so quickly. That's the reason why. So on a scale of 1 to 10 fundamentals, I'll give them probably about a 6 or a 7. Not bad. I wish the debt was a little bit lower. So my hope and request would be that they probably take a little bit more cash out and pay down their debt, because if not, the debt is already going to get to the point where it's going to be expensive to be able to service. Okay, on the monthly basis, strong move up after. So this was the IPO in 2021, stage two markup, stage three distribution, stage four markdown, stage one consolidation period, stage two markup, consolidation period again, moved a little bit down, stage four. This is consolidation and a strong move up. So on the longer term time frame, this is actually, just look at this. This is a very beautiful, there you go, somewhere over here also, just to show you that this is a very nice base, very strong base. And after the base has been built, this is looking like a stage two markup. Good markup on the long term. Strong base built, good markup. Okay, on the weekly chart, oh, this is a beautiful candle. That means it's going to move down a little bit and then move up again. So keep that in mind. On the weekly chart, it's starting to form a bull flag. Bull flag, essentially, this is the pole, this green candle that you can see in the month of, on the week of 12th of February, very strong. So it should move something like this down a little bit here, consolidate somewhere in the 50, 53 range, and then move up back again. I would like to see that move. That's a very, very strong move. Just look at how beautifully this is done. Every time they have a good strong green candle moved up, this one moved down. That's not a good sign, but this is what I would expect. So strong move up, consolidate, move up back again. Strong move up, consolidate, move up back again. Strong move up, consolidate, move up back again. That would be the kind of move I would expect. On the weekly chart, it's got resistance. It's got quite a bit of resistance in the $60 zone. So it's moved, tried to make a move all the way up there and then move down, whereas the support for it should be in the previous resistance, which is in the 45 zone. We'll adjust it a little bit later as we go along. Let's look at the daily chart. On the daily chart, oh, this is a 52-week high. That's one of the reasons why. 52-week high is in the $60 range. So it's off of the 52-week high. It's moved very, very well. So very strong, consistent move, good consolidation period. This is a complete consolidation period on the daily chart for months and months. It just hung out over here, consolidating, making not much of a move, and then a very strong move up after earnings. Earnings reported, 35% growth reported, strong move up. So my suggestion would be, this is going to consolidate a little bit. This in the short term is going to go like this. Overall, the market itself is taking a little bit of a break. So it should, somewhere around here, it should market down. And then once it does that, I'm going to remove some of the other lines. Okay, so it's going to move down a little bit. My ideal buy would be in the 47 range, which is the previous resistance. So this is the previous resistance, somewhere in the 47 range. I would like it to move down. Now, keep in mind, what I like and what does are two different things entirely. So people have always complained to me, you say it should go down here. We waited for it. Well, this is not science, guys. This is, some part of it is also an expectation of likely movement. This is probabilistic. It's not scientific. So will it come down to 47? I don't know, but I would like it to come down to 47. And most of the times it does end up doing what we expect it to do. So between 47 and 40 would be the ideal entry point, but it's not probably going to come there. This, if it fills this gap, because the overall market goes down, then that would be a very good move. Watch this carefully. Applovin is a good company. On a scale of 1 to 10, they have a very good fundamentals at 7. I'm going to summarize again for you why this opportunity is good. Growth at 35% over the last quarter, indicative of the fact that they're going to grow a little bit faster. Take a look at their earnings release from the last quarter. They really are expecting to grow much faster. AI advancements in their core engine is driving even more. And almost every one of the analysts upgraded their rating and the price. So you look at the forecast and the price, it's 60 right now. So it needs a little bit of a break. The expectation for most of the analysts is 88. 14 analysts have, one analyst is a sell, so that's not a good sign, but most of the analysts are a strong buy. I would go to an extremely strong buy only if I would say that this probably gets closer to the 40 to 47 mark. 38, I would just close my eyes and buy this. It's growing at 45% year over year. They've moved this thing around. They've also projected to be able to grow very, very strong going into the next couple of quarters. Just look at this. So Benzinga actually reported it about 4 years ago. They reported quarterly earnings of 47 cents, which beat the analyst estimates by 36%. They announced a share repurchase program, but that's because they freaking have so much money in debt. Their quarterly sales was nearly $1 billion, And the most important is they're expecting the software platform to increase 60% of total revenue from 40%. Remember, it was 40% when I showed you that graph. 60% means the margins go from 70% to 75, 80%. That's even better. Plus, their revenue growth is growing at about 30%. This is very, very good stock. But on the other side, keep in mind the overall market is stretched. I wanted to just show you this one thing. Okay, so look at this. Very good move, very good consolidation base built over here and then moving up. So overall market is a little bit stretched. To give you a little bit of context, beginning of this year, this was a $10 stock. It's gone up 5, 6 times almost in 1 year. 600% growth. This is just phenomenal. So keep that in mind. 700% growth, sorry. So it's gone up quite a bit. That means it needs a little bit of a pullback. It's done a very good job of just moving up into the right very well. Should you have bought it at 10? Absolutely. Can you buy it at 10? Not now. What would you rather do? Wait for it to come to consolidate. This is a very good demand zone. Ideally, I would like it to be coming back into this demand zone after earnings. It may never come back here. Just keep that in mind, right? I would like it ideally here. That's not going to probably happen unless the market has a big sell-off. But realistically, you should expect it to come anywhere between this $50 mark. It's right now at 57. If it comes between 50, if it breaks 50, watch for it and wait for the consolidation, and then it is going to move up again. Thank you very much for watching. Let me know what you think.